We are in the traditionally slow time of year, but the housing market is anything but boring right now. Inventory is shifting back towards where we were a year ago. Bidding wars are popping up in some pockets and disappearing in others, and mortgage rates are keeping buyers and investors on their toes. Everyone's trying to figure out what comes next, and today we'll help you do just that. I'm Dave Meyer, alongside Kathy Fettke, Henry Washington, and James Daynard. Today and On the Market, we're breaking down the headlines and trends shaping the end of 2025 and what they could mean for your investing strategy. You're listening to On the Market. Let's jump in. Kathy, Henry, James, welcome to the show. Thank you all for being here. Kathy, how are you?
I'm doing great. Happy to be here with you in December.
Henry, how are you?
Fantastic, man. Thank you for having me.
And James, what's going on, man?
Oh, just flying all around. Landed late last night and then up early in the morning. I'm ready to go.
All right. Well, let's jump into our headlines today. We have great stories about December housing market trends. We have updates on how investors are feeling about the market in 2026. Some interesting data about DSCR loan delinquencies, something we're all going to watch out for. And that headline that everyone has seen about first-time home buyers, we're definitely going to start talking about that as well. Let's start with you, Kathy. You're bringing some broad December housing market trends for 2026. Tell us what's going on.
Well, it's very interesting. And this is an article from Housing Wire, Logan Mohtashami. And it is basically what he's been saying for a long time, that if and when mortgage rates come down, even if it's a little bit, the closer they get to 6%, that will bring more buyers in. It will make it more affordable for not everyone, but for a few, for some people who've been on the sidelines who now can qualify because maybe their wages have gone up, home prices haven't gone up as rapidly, and in some cases, in some areas have come down a little bit. And then when you add a slightly bit better mortgage rate, you've got buyers. So that's what we've seen. We've seen pending home sales really increase just in November and possibly again in December. So I brought two articles. One is from November 17th, so it's a little bit dated, but the title is Despite Economic Uncertainty, Weekly Housing Demand is Up Double Digits over 2024. Increased 15% year over year, and it was 34% just earlier this year. So the big headline, as we've been talking about, was all this excess inventory. And there was this fear that, oh boy, we're going into, we didn't have that fear, but a lot of people had the fear that we were going into a 2008 situation where there'd be just massive amounts of inventory. The way that Logan Mohtashami has looked at it is like, more inventory is a good thing, not a bad thing.
Yes.
It's been too low. More is better. And then because there was more, prices came down a bit and now it's affordable and it's reversing. So people are diving back in. Again, not everybody, but enough people. And so inventory is being gobbled up in certain areas. So 15% more inventory than last year versus what was 34%. So then he writes another article, December housing data provides early signs for 2026, next year, which is what so many people want to know. What is this going to continue? And basically, he says, usually what happens in December is a sign of what's going to happen next year. And usually November and December are slower months, but that's just kind of not the case. So the early signs are with these, if mortgage rates stay low, then we'll see more of the same. However, he also writes in the article that Jerome Powell doesn't really want that. He doesn't really want people diving into the housing market because that could drive prices up, inventory levels could get low again. So he said, be careful because they're probably going to cut rates in December, but then Jerome Powell's going to say something like, yeah, but, I don't know, we're going to, something that will scare bond investors so that mortgage rates might actually go up to slow down all these buyers. Because what he says, the market reacts to so quickly. And so he could control it almost as like not even so much through rate cuts or rate hikes, but through what he says. But it's interesting, James, because you were just saying before the show that inventory is just not out there.
We have a lot of flip volume always coming through our office. And so we're comping houses, all different price points. And I will say for the last 2 weeks, every time we go to comp a house, we look at inventory and there's nothing for sale. There's little pockets, there's a lot more density, but the last 3 homes that we're actually listing for the $1 million zombie flips, we sold the first one in the first 5 days. And then the last 3 that we pulled up that we're getting ready to roll out, 2 of them had no homes for sale in a half-mile radius. 0.
Wow.
Yeah.
Which is even lower than, even 2020 in some of those neighborhoods.
But this is new, right? Because it seems like a month ago you were saying the opposite.
It's the seasonal though. So I think that's what it is. It's like you were just saying, when Jerome Powell speaks, everyone is like on pins and needles. And I think buyers, there's so much FOMO and fear in the buyer market that, it's like right now what we're doing is we're seeing this kind of push of sales, because I think people are like, oh, the spring's coming. And if we don't buy right now, it could jump. There's like so much prediction going on, because we are definitely seeing way more activity than we typically see. When we're listing a home in December, you're just kind of praying you got one buyer going through there that's serious. Typically, if you get a buyer on your house in December, that deal's locking in and that's a good buyer. But there's not very many of them. Now, I think the buyers are trying to get a jump start into the spring, and they're looking now. And I do think it's also who is looking for a home now. A lot of times the spring's hot because people want to buy a home, transition for a new school year coming in the summer, basically. Now, a lot of buyers don't have kids. And I think it's just you buy when you buy. And so combination of FOMO and the demographics who are looking, there's just a little bit more activity, and there's just nothing really to buy. I don't think there's that many more buyers. There's just that little of options.
I think it's just a normal reaction to the conditions we're in, right? We've been in a more of a buyer's market all year. And all the crash people point to that and say like, oh my God, inventory is up 30% year over year. It's just going to keep spiraling and it's going to be up 100%. There's going to be more and more inventory. The exact opposite is happening. Sellers are rational and they are reacting to poor selling conditions, and they're not listing their homes for sale. Like, people are saying, oh my God, there's going to be so much more inventory. I just looked it up when you were talking, James. For the last couple of weeks, new listings in Seattle are down year over year. Yeah,
Wow.
the pricing is soft, but people just aren't selling because they don't want to sell into the soft market. And so I think that bodes well for home prices staying solid, but I actually don't know if we're going to continue to get more inventory into next year if people just don't want to sell right now. So it'll be an interesting thing to see. But I actually think when you look at the market right now and look at the data, it feels like we're in a pretty balanced market. Like, there's not like a strong buyer's market, not really a strong seller's market right now. It's just a slow market with not a lot moving.
Yeah, my market is doing, I don't know, kind of the opposite of what James is saying. Like, he's talking right now and I'm like, man, I wish that was what was going on where I'm at. But we're still pretty slow. I mean, I've had 2 houses on the market. One is going on 90 days on the market. The other one is going on about 60 days on the market. Now, we did receive an offer yesterday that we're going to accept, and then I got a backup offer coming in. So it's like just now 2 offers came in on one of those flips, but it took 60 days, which is probably pretty normal.
That's probably
right? It's just
normal.
uncomfortable.
I just don't like it.
I just don't like it. I want someone to buy it in 2 days. But inventory is up here. We're around 4 months of inventory, which in our market, it doesn't signal a buyer's or a seller's market, but it's a pretty normal market. And so, real estate is always going to be local and regional. So you've got to follow your metrics, because what James and I need to be executing in our markets is completely different, even though we're doing the same thing.
And it depends on what the supply is. Like, yes, we're seeing more sales, but we are also not seeing sales in certain segments. Townhomes, tight sites, things with high density, not trading. They are sitting stale. And that's what we've seen a lot of that inventory come off the market, because developers are giving it a breather. And so you really want to look at what's your price point, what's the affordability sector, where's the velocity, but then what are you selling and how do you position it? If I had a bunch of townhomes to sell right now, I'm not putting them on right now. I'd wait till the beginning of the year.
Interesting.
But if you got a single family house that's good, livable, and low inventory, put that thing on. Who cares, right? Get an early Christmas present.
Well, I've got a single that's been sitting for 90 days. So somebody come make me an offer.
A low ball? You'll take a low ball?
I would take an average ball.
But so much of this is timing. I mean, me and Dave just had a house sit on the market forever.
100 days more?
100 days. But every time we comp this house, we're going, this is a great value for this home.
Yeah.
And it comes down to, so we got this little surge in activity. And I will say the buyers looking now, there's a little bit different, because the buyers looking in August wanted 5 to 8% off your list price. And we sold 2 homes in the last week where we were like around 2.5% off list. That's a good sign because buyers that are looking a little bit more serious rather than opportunistic too.
Henry, let's move on to you. I think you're covering a story that has been talked about a lot on social media recently.
Yeah, absolutely. So I am here talking about if the first-time home buyer is vanishing. And this is definitely catching my eye because I market mainly to first-time home buyers because typically that has been the largest pool of buyers. And it's a safer investment strategy typically because the price points are lower. And so a lot of flippers look to buy properties and then market them to first-time home buyers. But what this article is saying that, and it's from the NAR, the National Association of Realtors, their data shows that first-time home buyers now make up a record low, just 21% of all home purchases. And this is what really caught my eye. The typical buyer right now is age 40 years old.
It's insane.
It makes me want to cry, really.
Wow.
That's so depressing. It's awful. It's the worst.
And it's typically been somewhere in your 20s to 30s where you're able to make that first home purchase, right? It's the white picket fence. You start your family, you buy a home. But that affordability seems to have shifted. And now it's taking people in their 40s to be able to purchase a home. Also, down payments are up. They're higher than we've seen in decades. Around 10% is the median price of what people are putting down.
I was looking at this the other day. In 1991, the median age of a first-time home buyer was 28. That feels right to me. I don't know.
Yeah.
That's about when I bought my first primary. I was 29. And that felt about right, just like in terms of my maturity level to be able to actually like manage being a homeowner. Then it went up to, I think even in 2020, it went up, but only to 33. And then it's just in the last couple of years, it's just absolutely exploded. And I mean, housing market aside, this just feels bad for society. I feel like this is breaking the social contract that housing is this unaffordable. And although there are things you can do about it, like it doesn't seem like there's going to be a quick fix for this.
You know, I'm going to give a different perspective here because what happened over the last 4 or 5 years, or I should say from 2020 to 2022, was too quick of appreciation, obviously. You know, some markets were appreciating, prices went up like 25% or something in some markets in 1 year. And that was a policy issue. That was keeping rates low too long. And all of us could see it. Like, you know, don't you see? It's because rates are low that prices are going up. So it's a catch-up game. And so for me, we're just in this awkward phase where prices have already done what they should have taken 5 or 6 years to do. And at the same time, you've got this massive millennial generation who would be normally at first-time home buyer age bumping into this. So they're coming in when the appreciation happened already. So I would say give it 3 or 4 years and things might normalize. We'll see. But it's temporary, I guess is what I'm trying to say.
And I think the concern is more like long-term implications as well, because if people are having to enter the home ownership market later, they're giving up equity that people have normally been able to start building when they're younger. I think the article says on average, they're losing about $150,000 in equity by entering the market later.
Yeah.
And the people who are transacting now because they can afford it are leveraging the equity they have that they bought their homes when they were cheaper. And so the transaction volume is coming from people who have equity. And if younger people now aren't able to get that equity, how does that trickle down later? Does that compound the affordability problem? Because now this middle class, this second tier home buyer, this 50 to 60-year-old who's now making up the majority of second home purchases won't have that buying power because they weren't able to enter the market until later. So if something doesn't adjust, we could see a compounding effect, and it's yet to be determined how that's going to affect the housing market in the future. But I did have a question. I want you guys to guess. If the median home age for first-time buyers is now 40, what do you think the median age for repeat buyers is?
Oh, it's got to be in 60s.
No, I bet she's lower because people are buying and selling so much more now.
45.
I think it's 63.
I'm actually going different. 35.
35. Wow. Yes. No.
Well, because the people that bought and traded.
62.
Yeah.
62.
Oh, I was
Wow.
close. It's all boomers. It's just
All
boomers.
boomers.
It's just boomers.
Yeah. This is not a surprise. Boomers have all the money.
But also they're maybe in transitional times of their life. And
That's true. That's a common time to transact. Yeah.
That's what I mean about the compounding effect. The boomers have the money because they bought when the market was cheaper. They've been building up equity. They put down an average, a median of 23% down payment right now when they're transacting these second homes. And 30% of those transactions for that demographic were in all cash.
Amazing.
Wow. That's insane.
I also think that young people are just smart. You know, if it's going to cost twice as much to own a property that you could rent for half that, why would you not just rent it? And maybe they're investing in the stock market. Maybe they're investing in crypto. It's just not housing. Because the truth is, if they did buy a house today and their payment is extremely high, higher than it would be if they rented it, and they're not really getting a huge equity gain. I mean, values going up 1% to 2%. Maybe it's really just not it's not what it was for them right now. Like I said, I think it's going to shift. We're just catching up to where prices would be here maybe next year or the year after, but they got there faster. So there's a pause. So maybe it is smarter to rent and invest in other things right now for them.
I agree with that, Kathy. I also I'm going to be bold and defend Gen Z here because I will say, I think Gen Z is getting screwed economically. And millennials, I just want to call out, when we were all 23, do you know what every headline said? People don't save their money anymore. These millennials, they're acting irresponsible and they have credit card debt and they have student debt. Every generation just shits on the generation below them. That's just
It's like, what were you doing in 2010?
Everyone does this, okay? Us included. I do it all the time. But I will say, I think there's two things going on with young people. That one, do you know the unemployment rate for people under 25 is 10% right now? That's really
crazy.
bad. That's really bad. So like, I think ChatGPT and AI is not fully disrupting the labor market, but it is really hurting entry-level jobs, which is really tough for that generation. The second thing is we printed so much money from 2008 to 2022.
So much.
And all of the gains from that disproportionately go to people who own assets. And that has been very good for real estate holders. Gen Z, those people were in middle school and high school. So like everyone who owned real estate, for all of us, it was really beneficial for us. That inflated prices of assets, but they weren't old enough to own assets at that point. So there's this disproportionate shift that happens to them where they didn't get the benefit of the money printing, but they're suffering from the increase in asset prices from money printing. So I'm not defending Gen Z on everything, but I do think there are some structural things here that are working against them. James, what do you got for us?
Are we seeing issues in the DSCR loan market?
Oh, this is from James Rodriguez. He's a repeat guest on this show.
You know, it was a very interesting article because, you know, as rates shot up and affordability and debt coverage was not working out well for your traditional banks, what did a lot of people do that were flippers? They got caught with bad deals, or short-term rental buyers. They started running out of cash. They started doing a lot of cash out refis on their rental properties.
Yep.
And they started also forcing a rental. Like people were too afraid to take the hit on their flip, and they just are not covering their cost right now. And so what this article talks about is there's been a slow shift in the amount of defaults. So since 2019, 2022, average volume went from 5.6 billion to 44 billion annually in DSCR loans.
Oh my goodness.
And what we've seen is there's been a slight uptick in rising delinquencies. So securing a DSCR loans quadrupled in mid 2022 when people were starting to really get caught in that transition. And then now it's been reaching a 2% default rate in August of 2025. Now that's not huge, but it was less than 1% 12 months ago, and the conventional loans right now are around 1%. So it's trending higher because what we're seeing is a lot of people that are actually in trouble in the market right now are investors that are getting caught. And so, I think a lot of people that are forcing their short-term rentals, they're forcing to keep their flips, they're starting to drown a little bit in these payments.
I was going to say, can you explain what a DSCR loan is for people who maybe don't know?
Yeah, so a DSCR loan is where a bank is underwriting the property based on your potential rent income or rent income that you're collecting. So they're going to look at more what the loan to value is, what's your income, and they're going to qualify you based on the property rather than who you are as an individual. They're going to look at that a little bit. But a lot of these DSCR lenders were doing projected rents, not actually existing rents. Like, for example, I just refinanced 3 flips and I got no renters in them.
Interesting.
There's nobody in those, but I still went through the process. They knew what it is. It wasn't that I told them it was occupied either. It was just they gave it to me with being vacant. And so that is starting to creep up and catch people right now, is because, they're forcing to keep. Sometimes you got to sell your property.
Yeah.
Just get rid of it because you can't drown in the debt. And I think it's slowly starting to catch up with people.
I think this is super interesting because, as James said about these DSCR loans, these are loans that basically exist for us. Like, DSCR loans only exist for pretty much residential, retail, real estate investors. So, like, this is a really important thing for us because you see these delinquency rates on, like, FHA loans. Obviously, it matters, but, like, this is directly the people who are doing the same businesses that we are doing, going into delinquency 4 times higher than they were in 2022. I'm not super surprised by that because in 2022, everything was easy. And also DSCR loans weren't even that popular before 2022. And so, like, there weren't that many of them. So I'm not super surprised by this, but it is something to keep an eye on.
Yes. A couple of years ago, only 1% or less than 1% was defaulting. Well, there wasn't that many. There weren't that many servicers providing DSCR loans. There weren't that many investors using DSCR loans. And so a smaller percentage of them defaulting back then makes sense. But now, because it's gained so much popularity, every lender and their neighbor is giving out DSCR loans, and not all of them are doing a great job of underwriting DSCR loans. I have heard investors getting DSCR loans for properties that do not pencil, and they were specifically going to specific lenders to get those DSCR loans because they knew those lenders were going to be a little more flexible and give them a loan on a property that didn't pencil. And so I'm not surprised that the rate of people not being able to make their payments is going up. 1, for that reason. And 2, there's just a lot more DSCR loans out there. And there's a lot more unqualified lenders underwriting DSCR loans. And so, going from 1 to 4%, that seems, I don't want to say normal or okay. That's not what I'm saying. But as volume increases, your volume of delinquencies is going to increase as well.
Yeah, I think that's a really good point, Henry, about the lender too. This is a new loan product and they're probably not that good at underwriting it.
Yes.
I think they'll probably get better at it. Just like after the financial crisis, they tightened up underwriting rules. And now, even though we're in a weird economy, delinquencies on conventional mortgages are still pretty low, and so this happens. It's an unregulated loan. It's important to know though. Like, I think this is something I will definitely be keeping an eye on.
Well, and that's the concern is, like, after going through 2008, right, the liar loans, like, I was watching everyone get these DSCR loans these last 12 months. I'm like, what is going on here? And everybody can white label this DSCR product. The amount of salespeople selling this product, like, you could be a DSCR lender tomorrow. All of us. We could all sell the money.
That's right.
You do have to watch out for that, right? You have a lot of mortgage professionals who are not making money, and then they found something to sell.
Yeah.
That's a good point.
Salespeople sell.
Yeah, that is a very good point. All right, well, something we will keep an eye out for. We do have one more headline. It is from, I totally pulled a James on this one, Henry. I'm bringing my own article.
Oh, sweet. Yeah.
James.
You probably know this one pretty well then.
We actually did this survey of real estate investors heading into 2026 for BiggerPockets community. I'm going to share the headlines with you, and then I want to do some trivia and see if you guys can guess what people are thinking. So, all right, the good news headline here of the survey of the BiggerPockets community. We have over 3 million registered members. Wow. And I think it's an incredible way to get just a pulse on what's happening with residential, retail investors, and overwhelming optimism about 2026. And that's not always the case. If you look at the last year, I made this like index, 100 is neutral, right? Last year, 108. So people were feeling a little better. Looking into next year, 150. People are starting to
Yeah.
feel good about real estate investing again. And I think that's awesome. We also asked a question, what is your main priority as a real estate investor going into next year? Overwhelmingly looking to grow. People are not trying to sell off their properties. There is no panic here. A couple people, like 15% of people said they were going to like wait and see, but more than 50% said they are trying to increase their portfolio size in 2026. So I thought that was really cool. I don't know if you guys are seeing this as well, but I know there's like this crash narrative that like we have to keep like pushing out of the way. But I feel like for people who like actually know what's going on, optimism is like really increasing among real estate investors.
I would agree. I am optimistic.
I don't know. I'm seeing better deals than I have since like 2021.
100%.
Absolutely. Deals have been great right now.
Okay, so let me ask you, out of the BiggerPockets community, what do they think the best strategy in the next 12 months is going to be?
Ooh.
It's going to be house hacking or flipping.
I think it's going to be BRRRRs.
Multifamily.
Whoa, all over the place. I love this. Okay.
I think it's BRRRRs. Like it's because if you can buy deep right now on something that's a heavy fixture, by the time you get done renovating it and refinancing it, rates should be lower. And I do think rents are going to go up too.
James got it.
There's a magical little sweet spot that we're always looking for. And I really do think, you guys, it is a good time to buy something with some work that needs to be done. Go in the hard money, go to refi it. Your rates should be lower and rents might tick up.
Yep.
And that's where you catch that sweet spot.
My last two purchases, which I planned on flipping, I have pivoted and said I'm going to hold them just because the deals are so good. Again, real estate is so cyclical. When I first got in this game, you could buy a property that cash flowed pretty much on day one or right day one after the renovation. And then over the past 2 to 3 years, that's been very difficult. But now I'm getting deals at a price point again where after I renovate them, I can cash flow.
Mm-hmm.
And the last two properties I bought, one I'm paying $100,000, I'm putting 60 in it, and it's going to rent for $1,800 to $1,900 a month. And another one I'm paying $80K for, we're putting 50 in it, and I can rent that for $1,500 a month. Like that hasn't happened that cleanly in a few years, but now it's starting to happen again. So BRRRR, I can see where your point, James.
Well, owner-occupied house hacking and live-in flips came in second. I will just say, people are not happy about short-term rentals. Came in dead last.
Yeah.
Dead last,
Absolutely.
yeah.
Oh my gosh.
There's still some enthusiasm for midterm rentals, especially among newbies, but short-term rentals no one wants. Flipping's more popular than short-term rentals and midterm rentals, which I was surprised to see. At least among the BiggerPockets audience, it's more rental property investors, so I was surprised to see that.
I think it's going to be a good year for acquisitions.
Yep.
We bought more multifamily the last 24 months than we bought in the last 4 years.
Really?
There's just been heavy value add, some good buys. You got to be patient, but when you pull the right deal, you hit the right deal. Just be patient, but it's there.
Awesome. Well, I like that. I think what folks in the BiggerPockets community are seeing, opportunity, they're saying everything. Like we asked, like, what is the biggest opportunity for real estate investors? And there's just a lot of enthusiasm across the board. People are saying increasing inventory, lower mortgage rates, better ability to negotiate was number 2, and falling prices as 4. So I was happy to see this because I see falling prices and more inventory as an opportunity, kind of like what you said, Kathy. Logan says more inventory is a good thing. I think it's a good thing. Some people are like, oh, prices are going down. I'm like, yeah, that's called a sale. Like that's a good time to buy stuff. So the BiggerPockets community is seeing that. But we'll do one more trivia question. What do you think the biggest challenge real estate investors see? And I'll give you multiple choice. So here are the options. High mortgage rates, lack of capital for new deals, difficulty finding new deals, rising expenses, declining home prices, or flat or falling rent prices. Those are the biggest challenges. What do you guys think the number one answer was?
It's money's for me.
Money.
The money I feel like is there. It's the cost of the money and how long you have to have it.
Mm-hmm.
It's not the access to it. It's being able to afford it while you have it. Everybody can get it, but can you hold?
Well, it was actually really interesting. So it breaks down a lot by your experience level. So if you were asking a newbie, Henry, you're absolutely right. Lack of capital for new deals is the number one thing. Mortgage rates are actually pretty low. People don't see it at that. The number 2 thing overall was for difficulty finding good deals. But the thing that was amazing to me is for experienced investors, people who have done 10 deals or more. Number one, by far, it's not even close. This was probably the most dramatic difference in any of the stats, was rising expenses, insurance, and taxes. Like, people are really struggling with this when you have a large portfolio. So I was curious what you all think about that, because you're obviously all in that category.
When we audited our expenses about 6 to 8 months ago, when we just went through and said, where are we blowing our money out of our business? It was by far insurance. Insurance was the number one expense we had in our real estate business.
Yeah, and there's just not much you could do about it, right? It's just like one of those things, like, sure, you can shop around, but like, it's just kind of, you got to eat it.
Yeah.
We tried. We literally pulled all of our policies and what we were paying, and we shopped it, and it just didn't make sense to shift some of those policies. We shifted a couple, but it's just an expense we have to eat.
It's crazy.
It's insane.
It's crazy. I was just looking at my personal budget, like going into next year, like how much I pay for insurance, not just property insurance, just insurance on everything. It's so crazy how much money I spend on insurance every year. It's nuts.
Yes.
All right. Well, we've gone way over the amount of time we're supposed to record this show, so we should probably leave, but this was a lot of fun. Thank you.
Oh, as always.
Thank you guys for being here. And thank you all so much for listening to this episode of On the Market. We'll see you next time.